Hello, everybody. Thank you for waiting for me. Sorry, they had lots of things to do. Yes, participation. This is where we had electricity. Okay. Hello, hello, hello. Good evening again. And thank you for waiting so patiently. Okay. All right. I will start with, I hope you received in the Google Classroom our schedule for the rest of May. Okay. So today we'll try to finish chapter 13. And then tomorrow, and then we start on chapter 16. Chapter 16 is on financial performance measurements. Okay. So a lot of calculation, a lot of formula. We'll not be able to finish it today, especially now that I am 1 hour delayed. So we're going to continue that tomorrow. Why am I putting 18 and not 14? Because 18 is performance measurement of non-profit organization. So number 16, chapter 16 is performance measurements of profit-making companies. So I had to put it together. Okay. Chapter 14 and 15 are easy subjects. These are about sources of information, management information systems, okay, some theory, so not much of calculation. And of course, we end with 14, 15, 7, and 17 are all theory already, okay? So the two major ones are 16 and 18, all right? So, the last time we met, we were cut off with electricity. Today, we are delayed because of graduation. We are a perfect combination, isn't it? Okay? But nevertheless, we did already talk about behavioral aspects. This is chapter 13. Can you go to chapter 13? This was our learning curve. And learning outcome, not learning curve. Okay, learning outcome for this chapter. So, we already started talking about the impact of standard costing in modern times. We talked about Okay, how participation in budgeting actually help in motivating preparation of budget. So we did start talking about it already. Okay, so remember, this particular area would be a discussion question, not a calculation question. So probably it will be in section C, okay, of the discussion. But it can be also in the multiple choice area. So you can also, it's basically no calculation here. Okay? So, all right, so we said, all right, how do we motivate? Okay? So we were here in this page, I believe, when when the electricity popped the other day. Yes? Is that correct? Yes? All right. So what did we say here? We said, all right, budgets work if people believe that what the budgets are set are attainable. Okay, attainable means what? Means it is achievable. It can be achieved, even though it's above what is the current situation, but it is something that is achievable. Okay, so it will motivate, all right? And also, motivation to achieve standard depends also on how management encourages people to achieve the standard or the budget. Okay, one way that the management can achieve or can motivate people is by how they prepare the budget. Okay, in terms of people's or management's participation, lower management participation. Okay, there are three kinds we said: top down, bottom up, and negotiated. So I think we did discuss this. Which of these three, okay, is another term for this is imposed budget, wherein those who are the CEO, the higher level management would prepare the budget and just give it for everybody to exercise or execute. What do you call that? The top down. Okay, the top down. What would be an advantage for that? A top down. Less time consuming immediately, because only the few of them decide and only can approve it and get it executed. So less time, okay, more accurate, probably, okay, no more discussion. But what's the disadvantage? Yeah, less motivated, because people, in certain organization, if something is imposed and they know that they know better, that there are things that they know about their departments, and they were not consulted about it, then they actually get upset or get actually demotivated to actually achieve those budgets. Okay, so the solution there would be a bottom-up, correct? A bottom-up approach. A bottom-up approach is when now you get every department manager involved, okay, and discuss and get their points of view in establishing the budget. And what does the management do? They just need to review and approve the budget. Okay, that is more motivating. Now, that is good if the managers have the information and have the skill to prepare a budget, correct? Okay? Because certain industry, certain types of companies, their middle management don't have the skill or the knowledge to prepare a budget. So a top-down would be best. Okay? But if you have middle management who has MBAs and all the degrees that allow them to be able to prepare, they would like a bottom-up or a negotiated. Okay, unnegotiated budget where they all work together, whether it's top management or middle management. The only trouble with bottom-up and negotiated is, what is the problem? Time consuming. You understand? Because you have more people to talk to, more ideas to look into. Okay, so that would be the results. But in terms of motivation, yes, bottom-up, negotiated is something that will be motivating in terms of participation. Okay. other things as well. There are other negative effects of budget. For example, during the time you set up the planning or at the planning stage, okay, some managers, they do not want to communicate with other departments. Okay? They don't want to share. They don't want to coordinate with other budget centers. Okay? By nature of, they will say to you, oh, I don't want to discuss, I'm going to waste my time to do it. Okay? So things like that. But it's important to coordinate. Because how does the production manager know how many to produce if they don't coordinate with the sales department? Okay? Another thing at the planning stage, which is a negative effect, is that, slack. What is slack? Can somebody explain to me slack? I'm sure we've talked about it before. Is it waste? Wasteful spending? That is the effect of slack. Yeah? But what is slack? Oh yeah, so in reality, when you do your budget, you know you will spend only 10,000, for example, correct? But instead of saying, oh, I need 10,000 for my department, what will I say? I will say, I need 12,000. So there's a 2,000 budgetary slack. Okay? Why do I add that? Just in case, okay, I'll be inefficient. You understand? Okay? I'll be inefficient, so I will still be within my budget. Okay? That's called a slack. They actually add it to what it should be. Okay? Now, during the time when the budget is actually executed, there are also negative things that happen. Okay? For example, again, when now you put in action, because they did not coordinate with each other, okay, now what happened? They still don't communicate with each other. You understand? Why would I communicate? If before I planned, I did not communicate. So during the execution of the budget, they still don't communicate. Okay? Managers try to achieve targets, okay, but not beat them. What does it mean? Okay? Yes, it's like, for example, I'm a sales manager and they tell me, oh, you have to sell 500,000. I know I can sell more. You understand? Even the customer is telling me, can you sell me more? And you tell the customer, wait, I'll sell you next month. Yeah? Because next month it will add to my budget. Now already I finished my quota, 500,000. You understand? You only try to aim to actually reach what is dictated to you. But even if the customer needs it, even if the market can have it, but you just want to say, because the budget is this much, so I will just do the budget. You understand? Even if you can achieve more than that. Okay? Now, then, after everything is done, when it's time to compare actual versus budget, this is what they say. Okay? When you go to them and they say, and you tell them, this is an adverse variance, and say, whoa, it's not my fault. The first thing, and it's usual, isn't it? That is human nature. The first thing you'll do is just, no, not my fault. Anybody. Okay? So that is also the manager's attitude towards evaluation of their work. Okay? So, and you know what else they will say? Maybe the way you calculated the variance is not correct. You understand? They're skeptical how you calculate. Are you sure that you're comparing it correctly? Are you sure that the budget was correctly done? Maybe the budget was everything but their mistake. You understand? Everything else is wrong calculation, wrong budget setting. Okay? But as long as they don't accept that they did something wrong. Okay? So that is another negative attitude. In terms of when you do budgets actually. Okay? So, alright, so one of the things that we saw earlier was setting the budgets as targets. Okay? Now, remember, there's a tendency when you set standards that it's too perfect, too ideal, or it's too low, it's too easy. You understand? So, we must be careful that we do not do such, because in both ways they are what? they are demotivating. If it's too difficult, it's demotivating. It's too easy, it's also demotivating. Okay? So we need to make sure that we have and the managers make standards that are attainable. Not too easy, but not too difficult. Okay? Now, we talked about budgetary slack. We already talked about that, and we understand what it is. Okay? Right? So, what happened? How do I work this budget out? Okay, there are two things: the expectations budget and the aspirations budget. Let me explain it to you this way. When I was doing budgets in my company I worked with in Dubai, especially the sales budget, what we do with the salesman, okay, because the type of countries that we deal with are the Arab countries. And our salesmen are Arabic people, from Jordan, from Saudi, and generally these people are lazy. Okay, they're a little bit lazy. So you need to motivate them to actually work. Okay, lazy in such a way that when it comes to 1 to 4, they want to sleep. Like it's nap time after lunch, something, and they wake up. So you need to get them to push a bit. Okay. So what did we do? We actually had what do you call this? We had expectations budget and aspirations budget. We had to submit a budget to the UK, which is our head office. So what did we do? We tell the people in the head office, this is our expectation. Okay? Expectation. Something that we say is reasonable, we can achieve it, so this is the amount. Okay? But we turn around, we tell our salesman, listen, they want us to do this much, which is above expectation. You understand? Above expectation. So it's like an aspirations budget. More difficult than the expectation budget. Why? Because we know that they tend to what? They tend to relax a lot. So if you give them a little bit more push, they actually try to. So even if they relax a bit, we still are within the expectation budget. Do you understand? Okay. But be careful. Be careful with this because you have to manage this very carefully as a company. All right? Because they will tell us, why did you tell us to do this when actually it's only not this? Okay. So remember, there's a way to get it done. Okay. There's a way to actually get the aspirations, which is a little bit more difficult, to get done. Okay. What did my manager do? My manager would tell them, for example, okay, if we get this aspirations budget, the entire office and all the salesmen will have a trip to, for example, the middle of North Pole, for example, something like that. We actually went to North Pole once. Okay, not North Pole, but near the Arctic, because they were able to get the budget. Imagine, okay. So if you really, it depends also on the kind of people you have. Okay, you have to understand the type of people you have, the type of country you're dealing with, and we know that the type of people we have are. If you give them something that they're going to work on, they're going to like kill to get there. You know how war freak they are, isn't it? You know that they're into war with each other, so they try to. You have to play with the kind of culture that they have. So it's a little bit, you have to manage well these kinds of budgets. So expectation is reasonable, aspiration is a little bit more difficult. So you can have a two-phase budget depending on how you want to achieve it. Okay? So, also, all right, there is, in companies, there's the blame culture and the, what's the other one? Improvement culture. Again, it comes to number one, culture of people. Number two is how the manager, the CEO, the managing director manages people. You understand? Sometimes you establish the way that people don't use the blame culture, but make it as an improvement culture. Okay? So it really depends on how the management plays or works around budget setting. Okay? So, we talked about top-down, bottom up. So top down is good for who? Look at this. New companies. Makes sense. Correct? Alright? So because it's the managers who know about the situation. So for new companies, top down is good. Very small businesses, yes. Let's say family-owned businesses, correct? Top down is good. During economic hardships. Okay, really, it's a dictator with that one. It's because there's only limited supply, limited budget. Okay, or what did I say earlier? If my operational managers don't have the skills, top down is good. Okay, all right. And there are different organizations that requires precise coordination. Okay, so it's a top-down approach. For example, if you were NASA, the space station, the space agency of the US, okay? You don't do participation, you do a top-down because of the type of operation that they have. You understand? You don't get everybody to dictate what needs to be done. Okay? Bottom-up budgets are effective if you have a well-established organization, something that has been running and managers know the businesses very well. Very large businesses, especially if you have branches, you have divisions, okay? And of course, the opposite of economic hardship is economic affluence. Means that it's a good time to do business, okay? Business environment is good, okay? So you have more chances to actually be more relaxed in getting things done because it's easy to achieve budgets, okay? When your operational managers have very good budgeting skills, okay? And if your organization is such a way that each division is autonomous, what is autonomous? Can function in its own, you understand? Some companies, they have autonomous divisions. In other words, the manager of that division almost acts like the CEO, the small CEO of that area. So again, you can have a bottom-up approach. So, if you get your people to participate more in budget setting, what are the advantages? Number one, it's more realistic because people know already contributed to that budget and they already know that it can be done. Okay? It's a good way to coordinate. It increases morale and motivation. Okay? And because they were participating, the budget came from their idea, then they actually are more committed to get it done. Okay? The other disadvantage we already saw, time consuming. We know that there can be budgetary slack, okay, and we know that some of these when you ask people to do their own budgets, some employees are afraid because they know when they do not achieve, it will come back to them. Okay, so that is also the disadvantage. Okay, they get to have they get to be afraid of the budget instead of motivating them. Okay. All right. So, modern business environment. Okay, wait a minute. I don't understand. Can't remember what is WCM. I know TQM. What is TQM? Total Quality Management. JIT, just in time. What is WCM? Let me see if they tell us somewhere here. I don't know what is WCM. Okay, so let's talk about the one I know. TQM. Total Quality Management. What is the idea behind this? You get it right the first time. Okay, this is a Japanese concept. The Japanese concept of every time they make a product, every process, every stage means that if you're doing it in process 1, you have to make sure that you come out with a good output. Okay? Because then it becomes the input of the next department. So you need to be able to get it right the first time. And in TQM, there is continuous improvement process. Okay? Continuous improvement process. In other words, employees who are doing the process are asked themselves to make improvements continuously. Okay? So they can suggest how to improve their process or how to improve the way that they work. Okay? So it could be, that is TQM. All right? JIT, just in time. In other words, just in time is when you buy the materials, when you need it. Just in time is the production when the customer needs it. In other words, there will be no inventory. You understand? So that is the kind of, so they will only produce what the customer requires. They will only buy at the time that they know what the customer requires. Okay? So, all right. So, TQM. Okay, the philosophy is zero defects. In other words, when you produce something, it must be perfect. It must be right. There should not be any defects. Okay? So therefore, any variances, okay, all right, will come into focus. Any variances. Because remember, it has to make sure that it is done correctly. All right? What did I tell you, TQM? All personnel, whoever is in charge, not only the quality department, every personnel who is doing the process or manufacturing is responsible for the quality of their output. Okay? Alright? So, remember, in standard costing, we will only know the defects or the difference only at the end of the process. Here, during the process, they make corrections already. Okay? So, at the end, there will be no variances. Okay? So in TQM, because there is need to make sure that the product is correct in its output, there is continuous improvement. Okay? They can alter the way that they work. Okay? So, which means there is no waste. Okay? There is no defect. Because at every stage, quality is assessed. Okay? Now, which means, if we get it right the first time, will I have variances if there is no wastage? Okay? Now, if there is no wastage, there will be no variances. Okay? If there is continuous improvement, there is no variances. So variance calculation is not present in a TQM environment. Okay? Because there will be no difference. Because first and foremost, the process also changes. Okay? They keep improving the process. So really, there will be no variances. How about in JIT? Okay? In JIT, what happens? They will encourage, if there are idle time, they encourage managers to use this in a productive way by producing more and building up inventory. Okay? But in JIT, what happened? Okay? Okay, they will what? What did I say? They don't want to build up inventory. Okay? They don't want to build up. Because in normal business, if you're not doing anything, people will ask you, okay, work more. Okay? But in JIT, they won't work until someone tells them what is needed. Okay? Because there are no inventory. Okay? Okay? So, in variances, okay, so if there's increased inventory, this is not, okay, this is not acceptable in a JIT. Alright? Alright, so, okay. In a modern environment, what is the impact on standard costing? In modern environments such as TQM, JIT, there are usually very high overheads. Okay? For example, making that cell phone, making other products in these modern times, we see that they have very high overheads because they have many equipment. Okay? Now, what happened? How does it impact the standard costing? Okay? So overhead variances, okay? Overhead variances is what you're going to look at more. Okay? There will be more of overhead variances in the performance measurements. Okay? Now, what happens? If the products and the working environment keep changing, what happened? You keep revising the standard. You remember we talked about revision of standards? Okay? So if you have an environment that keeps changing, which is happening nowadays, what do we mean environment? The way that you do things. Technology keeps changing. Sources of materials keep changing. So what happened? Your standards keep changing. Okay? And we said it's very difficult to be keeping the standards to keep changing because it is demotivating. Nowadays, people would actually prefer more customized products. Okay? Customized product. What happens then? If it's customized, can you prepare a standard? What is it? No, because standard only are for homogeneous product, correct? Okay. So then you don't have much of it's very difficult to actually calculate variances because you don't have a standard product. Okay. Now focus on quality. Okay. The focus on quality again goes back to our TQM. In our TQM, if your focus is on quality, you keep revising the process, you keep changing, so therefore, what happened? Your variances may not be something that is useful in this case. Okay? Alright? And also, if we keep changing and focus on quality and keep changing the process, of course, there are costs involved. You understand? Okay? You keep changing the process, you keep changing the material. What happened? The costs will be higher. What happens to your selling price? Will be higher. Okay, so the only thing that you'll have is a price variance. Okay, JIT philosophy. Okay, all right. So they don't want inventory to build up because they think if you build up inventory, then you have inefficiencies in terms of managing of inventory. So what do they have? They say they will ask you to improve your efficiency variance. They don't want to build any inventory. Okay. All right. So what are some features of the environment that businesses now have to operate in? Okay. What are they? All right. Let's talk about this. All right. First, which means that it's no longer like before, standard costing where you have one process, you go in and produce, etc. One is globalization. What does that mean? When you say globalization, give me an example. Where does iPhone get its phones manufactured? In China. Okay. Where does H&M get their clothes manufactured? H&M? Cambodia. Okay, Cambodia. Levi's, Cambodia. Okay? Gap, Cambodia. You understand? So, it's a European company, it's an American company, but it's produced somewhere else. You understand? Where do they have the North Face bags and shoes done? Vietnam. You understand? So, that is what you mean by globalization. Businesses now are internationally dispersed. Okay? Manufacturing is done in one country, but sales is done in the other country. Okay? Globalization. Then you have multinational companies. Okay? So you have multinational companies that are based in different countries. Alright? Then you have companies who franchise their business all over the world. Okay? So these are some of business environments which actually are more different than just a simple standard process. Okay? Changing attitudes to employment. Okay? What happened here? For example, instead of hiring your call center or your customer service in the United States, okay, the company is in the United States, but the customer service department is in India or in the Philippines. You understand? So you call the company to have a complaint. You think you're talking to somebody in the company, but actually you're talking to someone in India who's actually dealing with your complaint. You understand? It's called call centers. Okay? Call centers. So changing attitudes to employment. Okay? More companies are competing to sell the same products and the same services. More demanding customers. Okay, we want this type of product, that type of product. They want more personalized products to what you want. Okay, increased emphasis on quality and reliability of output. Okay, nowadays people realize that buying things that are, for example, sorry to say, made in China that only lasts for a week or two, they would actually, even if it's cheaper, they actually would like to pay a little bit more, but will actually be serving them for a long time. Okay, so people now are really thinking about quality. So remember, if people are thinking quality, then it goes back to the TQM. Okay, TQM. Increased importance of customization of products and services. Okay. Introduction of new technologies, the way manufacturers work, the way things are produced. Okay, newer technologies are used. Okay, so it's more digital rather than analog, for example. Okay, it's more computerized rather than manual processes. Okay, again, it will affect also employment. Okay, so these are the things that we need to consider. Cost is not only the competitive weapon nowadays. In other words, even if you cost less, you still are not competitive because you have, for example, not a very good marketing system. You understand? Or your product in itself is not good. So it's not just the cost now that makes you competitive. There are other things. Okay? So what does it mean? Why do we talk about this? Because, alright, standard costing is and variance calculation is like, for example, when you had things done in a standard process. Okay, but new business environment does not require us to do standard anymore. Okay, because this is what is our new business reality is. Okay, so these are the things there. Okay, so what happens? Standard costing in opposite of this, concentrates now, okay, on narrowing the range of costs. Okay, so we are emphasizing on cost, okay? But there are other things that needs to be actually dealt with, okay? We have to, it relies on repetitive operation. We said now, people don't like products that are the same. They want it more customized, okay? But standard costing is on things that are done repeatedly and therefore the product is homogeneous. We buy the same product. Now remember, people now like something different, okay? Like something that is built for their own, okay? Business environments are very dynamic and unstable. So if it's dynamic, it keeps changing. It's not the same. Can you set up a standard? What did we say? You cannot set up a standard. Okay? Because it keeps revising and revising. Okay? Alright, so alright, when we do standard costing, sometimes the information we do is not produced on time and therefore managers cannot decide accordingly. Okay? So those who does not like, okay, standard costing, they don't believe in budget setting, okay? Right? Says, for example, I don't like standard costing because in standard costing I need to have a stable environment. But the business environment, as we see, is no longer stable. It keeps changing. I need to have regular supervision. Okay? There is no incentive to do better than the standard. In other words, if I set a budget, there is no incentive to be better than the budget. Okay? So we are working only to achieve the budget. Some people even say, if you set a budget, okay, it's like you're working to achieve the budget. You're not working to satisfy the customer. You're not working to make a better product. You're just working to satisfy a budget. Okay? So people do not like budget setting because of those reasons. Okay? Now, so you would ask them, why do we talk about it? Why do we have to learn variance calculation? Why do you have to learn budget setting? Okay, what's the reason? Because still, but companies need to plan. still they need to quantify their budget. Okay? And sometimes that's the only way to do it. Okay? Now, in certain companies where their product is really homogeneous, let's say Coca-Cola, let's say whoever makes water, it's the same product they make. It's homogeneous. So still, they need to do standard costing. Okay? Alright, so sometimes when you also build a new product, you still need to start with a certain budget, okay, at the start. So you still need to understand how it's done, okay? And of course, we know that standard pricing or putting up the budgets is good for setting up the pricing at the beginning of the business. Do you understand? If I don't estimate how much my product costs, how will I know how much I'll sell it? Okay? And if I don't know how much I'll sell, how do I know the market can buy it? You understand? So you cannot really start a business unless you have this basic information. Okay? So when you do your business plan, you still need a standard price, you still need a standard cost. Okay? But of course, what you can do with standard price or standard information, if you have standard, when you set up the standard at the beginning, you can actually monitor the trend. Where you started, where you're going. So it gives you a kind of like way where your costs are going, where your prices are going. And lastly, of course, part of our accounting means that we have to value our closing inventory, correct? Okay? So unless I know how much is the standard cost, I will not know how much is the items in the inventory. Okay? So that's one way of putting a value into inventory items. So still, we need standard costing, even if we have a modern environment. Okay? So, to summarize this particular chapter, we talked about using variances in terms of variance analysis, and we said we have to start setting the budget and see how it actually what's the difference between actual at the end, and how we saw how it helps motivate the people in an environment. We saw the different behavioral implication, okay, before the planning, in the execution, and after the execution in terms of control. We saw how the different negative behavior of people towards variance analysis. Okay? Right? So we talked about how to set an aspirations. What's the difference between an aspirations budget and what was the other one? Aspiration and expectations budget. Which one is higher? The aspiration one. Very good. And we talk about how participating in budgets can help a company, or what are the different types of participation of budget setting. Okay, so and how it helps in the process. Okay. And in the modern environment, such as the TQM and the JIT, we saw that really variance calculation is not something that will help in their businesses. You understand? Because they have a different way to approach a business. Okay? Although standard costing is still used in planning, control, and decision making, however, in TQM and JIT, those variances may not be existent, okay, except for pricing, of course, okay, as we discussed earlier. Okay. Good. So, where did it came out in their last exams? None. You see? Usually I have something here, correct? Yeah, so no questions on any of these, but should it come out, just be ready, okay? But not really that much. Okay? Good. Any questions? Still need to discuss it. Alright? Okay, so if you don't have questions, I have, sorry, need a break? You want to go to the toilet? Yes, okay, wait. Did I give you a question and answer about this chapter? Yeah, so anybody who needs more, please come and get. Did I give you chapter 16 as well? Yes. Yes, okay, good. So if anybody who needs it is here, so let's take a 50. Okay, 15-minute break. I'm not about to say 10-minute break, but what did I give you for chapter 16? Did I give you a question as well? No, okay. Me. Very cool. Oh no, it's not here. No, somewhere. Sorry. There, there. Yes. There, no. The remote control here. Bottleneck is limited factor analysis, which is in chapter 4. Over there. Yes. 4, 5, or 6, somewhere there. It's in the second area. Yeah. Which one did they not spend? The budget was lowered to 8,000, from 10 to 8, the budget. Um, 8,000. So they did not spend the budget, but they also did not do what is their objective. And they're underperformance. Yeah, because if they want to go over the budget, but to go below the budget, but they did not do all their activity. No, that is not good. That is underperformance on everything. Because the budget was there, supposed to be to get them to do their work, right? But if they try to do not to spend and they did not do their work, then that's underperformance. Underperformance. I'll just go to the toilet and I come back and start. Okay, I know we have only until, I thought we had until 9 o'clock, we only have until 8 o'clock, sorry. Otherwise your parents will kill me. Give me 2 minutes. Or why? Yes. Yes, world class manufacturing. Yes, correct. Yes. Okay, yes. Correct. Yes. Yes. Oh my God, how did I forget that? Let's go back a bit. Just to tell you like this. Thank you. back, everybody. I know that we're going to take just an introduction on chapter 16 before we have to leave for tonight. But let me go back. WCM is world-class manufacturing. Okay? This is what I was actually defining to you earlier. World-class manufacturing means that now manufacturing processes, okay, are done anywhere in the world but still have the same high quality. You understand? So, even if it's done in Indonesia, in Cambodia, but the output still has to have and reach a level that is set by whoever is the first world country. Okay? So, world-class manufacturing. Quality is going to be standardized even if anywhere it's produced. Okay? It allows companies to be flexible. Okay? In other words, if it's very expensive to produce it in for example, in London, in the UK, they can actually get it manufactured somewhere else in the world, and the quality will still be the same. Okay? And also, all right, it also makes what do you call this? Even if it's made somewhere else, it is still reliable. Okay? In other words, even if the manufacturing company is in the Philippines, in Cambodia, in Thailand, okay, in Indonesia, in Malaysia, okay, the manufacturing process is still reliable, okay, because it has to adhere to certain international standards, okay, and that's why you have the ISOs nowadays, correct? The standards that even if wherever you are in the world, they will establish if you are following a certain standard. Okay? So this is one of the other characteristics of a modern business environment. Okay? Okay. All right. So let's do an introduction on chapter 16. What is it all about? So by the time you reach home tonight, you can dream about it. So tomorrow we can actually explain it a little bit more better. Okay. So let me just. Sorry, I need to reduce this, otherwise you can't see. All right. Okay. So what are the things that we're going to talk about here? Okay. We're going to learn to calculate performance measurements. Okay? And there are two things as well we need to look at. We need to look at balance scorecard, and there's one more missing there. It's called a building block. Okay? Building block. So let me show you. So first, we are going to learn to describe, okay, here, describe, and very importantly, calculate and interpret. This is exactly how the examiner will test you. They will ask you to calculate and then tell you to interpret the financial performance measurements. FPI, Financial Performance Indicators. On which time? We will talk about financial performance that shows profitability, financial performance indicator that shows liquidity, and it also in risks. Okay? So we will learn how to calculate that. But also, we will learn how to work with non-financial performance indicators, NFPIs. Okay? In other words, not necessarily the dollar amount, but it could be the number of complaints, okay? The number of people leaving the company. So it's still numbers, but not financial. And also, we're going to also need to be able to analyze past performance and suggest to companies how they can improve these performances. So unless we know what the financial performance indicators or the NFPIs are, then we will not be able to understand how to advise or suggest improvements. So very important to note, we need to learn to calculate and interpret, and suggest ways to improve. Okay? Now, right? We also need to learn how to explain what is a short-termism, okay, and how financial manipulation can be done so that the performance measurement will be better or nicer. Okay, it can be done. It is done sometimes. Okay. Another two kinds of measurements aside from financial performance measurements is called a balance scorecard and the building block. So these two we need to actually to explain it and interpret it. Okay? So these are the other two things that we need to learn. Okay? Right? So we're going to start with performance measurements. And then we're going to study and look at organizations and calculate some of the ratios. So we're going to learn that. And then we go to non-financial performance indicators. So first we will learn how to do all the calculations first. Okay? So again, we need to look at financial indicators first, this one. Okay? Then we look at the non-financial indicators, and as well as balance scorecard and building blocks for service industry. Okay? And we will look at and talk about short-termism. Okay? So this is a summary of our learning outcome. Okay? So you need to be able to do the calculations here. So we need to know what are the formula under profitability, what ratios are in liquidity, and what ratio is that measures risk. Okay? Now, right? So we talked about that. Where do we have this? These questions are normally, okay, in section C of the exam. Okay? Normally in section C. Does it always come out answer? Yes. Because this is the overall essence of F5. What is the title of this? Performance management. Okay? In performance management, it really includes financial performance measurements, non-financial performance measurements, and sometimes you use balance scorecard, or in service industries, they use the building block. Okay? Very important. Now, remember, okay? What is it when we measure performance? We measure between actual versus the plan. Okay? So there are two measures that we will be looking at. The FPIs and the NFPIs. Okay? Alright, so the most common things we said, you compare actual results with the budget. Okay? Or you compare performance during the period and the performance in the previous period. You understand? That is also a comparison. Alright? So there are two things there are many ways to compare. Compare your results with the budget. That is called a what? What do you call when you compare with the budget? What do you call that? The variance analysis, correct? Okay. Or you compare this year versus last year. Okay, is kind of like an analytical analysis. It's an analytical procedure if you were in audit, isn't it? Okay, but it's still analytical analysis, analytical procedure. Okay, so first we talk about profitability. Okay, now in our profitability formula, but in our syllabus, profitability, we need to be able to learn three things: profit margin, return on capital employed, and asset turnover. Okay? Now, in liquidity, we need to learn current ratio, quick ratio, receivable days, payable days, and inventory days. Okay, don't worry, we'll look at the formula maybe tomorrow. Risk, we will talk about gearing and interest cover. So this is our financial performance indicators. Okay? So remember, when we do performance measurements, there is such a thing as cost versus benefit. Okay? And we look at performance must be measured in relation to something. In other words, what does it mean cost versus benefit? Okay? Means that when you do the process of performance measurement, you also need to look at how much you're going to spend to do that measurement as against the benefit that you get from having analyzed, okay? Analyzed those performances, okay? Now, why is there cost? Because when you analyze performance, you need information, okay? You need information. Now, sometimes this information may not be readily available in the company. So what do? You have to get them from external, and or you get people externally to actually get you that information. Sometimes it is not for free. Okay, for example, if you download the information, you have download fees. If you have to get a marketing department to get, for example, you want to know how much you're doing in the market. Now you will not be able to do that yourself, but you have to get a marketing team to actually analyze what is in the market. Now that costs you money. Okay? Now, the question is, the cost you're going to spend to analyze your performance in the market, how much benefit will that give you? How much will it help you the company be able to improve on your performance? If the benefit is higher than the cost of getting the information, go ahead. Okay? But if the cost is more than the benefit, maybe you need to find other ways. Okay, to measure performance. You got that? Okay. Also, when you're measuring performance, you have to make sure that you're relevant and you are fair. Okay. So you must make sure that you get the proper information when you're measuring performance. Okay. All right. So you also not need as a management accountant. You need to talk to management what performance measurements are useful for them. We just don't sit down and start calculating because our teacher in ACCA said you calculate this, and then you try and show them all the calculation, and you wasted your time because really the management says I don't need that. Okay, you understand? I only need this and this, depending on what they want. So you need to make sure that what you do as a calculation is relevant to those who need it. Okay? And when you measure something, measure it on a regular basis. Why? Because the management can be able to see the trend. And the trend can also help in decision-making processes. Yes. Let's try to see over the world. All right. Or you're exercising your neck. Okay. And of course, you have, okay, there are many ways to measure performance. Okay? Measure performance. And be careful because there are performance measurements that distorts the actual results, okay, the actual performance. So be careful on what kind of measurements you're using. To distort means to what? To change, to, what's another word for distorting? To make it, to make distorted. Distorted means it's not, it doesn't give you the correct picture. Yes, I think that's better qualification. Okay, so, right, so, because of numbers can distort, companies also, financial information can be distorted. What other companies do is also look at NFPIs, non-financial performance indicators, because it gives a bigger picture of how the performance of the company is doing, not just what you find in the financial statement. Okay? So it also talks about, for example, quality. It talks about customer satisfaction. You understand? Yes, you probably have a very good profitability, but then because you sold a lot, but you didn't know that customers were trying to return goods because they had so many customer complaints. Unless you see this, you think that, oh, they're doing good, but really, there has been complaints coming in. So really, is it really a good sale? Okay, so it's a mixture of both financial and non-financial. Sometimes the non-financial indicators tell you also how good you have, how good business you will have in the future. As I said, the example, you sold and sold and sold and sold. So what happened? Profitability is high. But then you didn't see that actually the customers keep complaining now, complaining, complaining. So what happens to the future? The future, your sales will go down. Okay? So if you're only looking at the financial, you're not looking at the non-financials, okay? It may give you a distorted view of the performance, and therefore a distorted view of your, what will happen is that your decision making as a manager will be different. Okay? It will be different. Okay? So it's good to look at it in different viewpoints. Okay? All right? How do you make sure, how do you know that you're doing well? Okay. It can be number one, you compare with other years of the same company, or you compare with the same, your performance with the same company in the same industry. That's another way to benchmark. Because once you calculate performance, how do you know that the 20% profitability is good? Okay? So there are things that you need to consider. Compare it with your past. Compare it with other companies in your same industry. Okay, because maybe you're only looking at it in a short-term method. So you need to be able to look and compare with industry, with other benchmarks, with your past results. Okay. So tomorrow we will start calculation. Okay, we will start looking at the formula and start calculating. I will also give you examples that we start and practice more so that you will remember how it's done. Okay, got it? Okay. So thank you very much for patiently waiting for me tonight. That's it. It's good. Is it 1 more hour? Oh, sorry. My lunch. What's happened to my lunch? What time is it? 7? Oh my God. My watch is already 8. Oh, sorry. Let me continue. Sorry. Why is my watch 8? Oh my God. Okay. Oh my God, it's gonna be 9. Oh, shush. Okay, sorry. I am in the Philippine time. Okay, alright. So we continue for sure. Okay. Thank you very much for reminding me. Alright, so profitability first. Okay. Thank you. Profitability first. I said, oh my God, I don't think I'm owning. Oh, it's really. But look, what does it say? It's 8 o'clock. Apologies. Okay, so, alright, get ready. Okay, here we go. So first is return on capital employed. Okay? Now, remember, it's PBIT divided by capital employed. Okay? Now, question is, what is capital employed? Okay, so it is either equity plus long-term debt or it's total assets less current liabilities. Correct? Okay, so you know that. Okay, so what does it mean? It means that how effective is the company using its capital employed in generating what? Profit. Okay? Profit before interest and taxes. Okay? Alright? So PBIT, okay, divided by sales, multiplied by sales divided by capital employed. Okay? So if you take PBIT divided by sales, it's actually your net profit margin. Yes? What is this one here? Is your asset turnover. So sales divided by capital employed is your asset turnover. What does asset turnover mean? Asset turnover means the capital I employed. In other words, the non-current assets I have, the cash I have. Okay? How do I use it to generate sales? Okay? How efficiently are you using your investment to get sales? Here, it's measuring what? How efficiently you took the sales and convert it to profit. Okay? Could take the sales and convert it to profit. Okay? So you want this one to be what? As low as possible or as high as possible? As high as possible. How about this? Asset turnover. Do you want it as high as possible or as low as possible? As possible. You want, for every dollar of asset you put in, you want it to generate you more sales, because the more sales you have, the more probability that you will have a profit. You understand? Okay? Unless you don't manage your expenses, then you will not have a profit, correct? Okay? But if you look at net profit margin, and I will multiply it with the asset turnover, what do you think is the result? I multiply this formula with this formula. What is the result? Yeah, what do you have? Yeah, PBIT divided by capital employed, which means it is what? ROCE. It's the same formula. Sorry. It's like this, correct? Okay. So if I have a net profit margin and my asset turnover, if I multiply it, it will give me my ROCE. Okay? Now. Okay? Now. Nice. Nice to have profit. Nice to have turnover. What's turnover again? Sales. Okay? Sales is what you get the first time. So it's vanity. The higher the sales, the better. You're happy, correct? Okay? But then, don't be too happy, because profit, if you have a lot of sales but you don't control your expenses, then you will not have profit, correct? Okay? However, what is more important than everything else is cash. Okay? So yes, you have good profitability, but you have a very poor liquidity. Okay? The business is still going to be in not a good situation, correct? Okay? They say that yes, you can go through your business without with having losses for maybe 2-3 years. But if you have cash flow, cash shortages, even for a few months, it may lead your company to be closed. Understand? So important really is cash. Okay? So how do we calculate liquidity ratios? Okay? But before I go to liquidity ratios, okay? Liquidity ratio. Do you have a, wait a moment. Do you have a handout that looks like this? It says additional handout. Do you have this? No. Okay, all right. So you take this because I'm going to ask you to calculate. So take a look, I'll put it on my screen. And I need you to calculate certain things for me. Okay. have in front of you actually. Below it says are the financial statements for T. T is the company. Okay? Now, for years what? Year 2005 and 2006. What kind of statements do they give you? One is an income statement and the other is a balance sheet. Ladies and gentlemen, in the exam, especially if they ask you to calculate financial performance indicators, they will give you the financial statements. And it's up to you to look for what you need to calculate. You understand? Okay? So if I were you, I would try to understand first how the numbers are placed. Okay? So you have revenue. Can you look at your financial statements? Okay, income statement to verify that you understand. Because sometimes the format of their financial statement is a little bit odd. Okay? So don't just take the totals. Okay, and think that, oh, this is the total asset. This is a, check the calculations first. Take a look. Okay, understand your financial statements. Okay, understand your financial statements. And when you do, when you finally do, I need you to calculate two things. Right? So let's start with profitability. Okay, so what I want you to look for is for 2 years, I need you to calculate gross profit margin. What else? I want you to give me net profit margin. Okay? And also asset turnover and return on capital employed. Can you do that? first one that you get. Gross profit margin. Did you get it correct? How many percent in 2005?
60%.
Okay, very good. It is 60%. Okay, what did you do here? It was what? 90,000, correct? Divided by what? 150,000. Okay, 150,000. Is that correct? 150,000. 90,000 divided by 150,000. Now, 90 million. Yes? You understand? It's 90 million, correct? Yeah, okay. So just to make sure that you understand what you're looking at. So it's in millions, see? Yeah, okay. So it's in millions, correct. It's 90 divided by the sales. So the next year will be what? Next year is how many percent?
63.
Okay, so 63 point what?
80.
Okay, so 63.9%. Is that correct? Okay, so it's what? What did you do? It's 115 million. Okay, 115 million divided by 180 million. Okay, so that's how you did it. All right, net profit. Still, if it's net profit, it is still divided by sales, correct? Okay, so what is our net profit?
25%.
So the first one is 41%, is that correct? Yes or no? How did you get? What is the profit? What profit did you take?
61,100.
Yes, 61,500,000. That is your profit before interest and taxes. What's another term for PBIT? It's operations profit. You understand? Profit from operations. Okay? Before you do finance, before you do tax, your profit before interest and taxes is called your operational profit or profit from operations. Okay? So, this is what you get. Not the net profit below. Not the 37 million. You understand? It's your PBIT divided by sales. Okay? So PBIT divided by sales. Okay? This one is of course gross profit divided by sales. Okay? 2006. How many percent? 41.7%. Okay, so what is our PBIT there? On the year. 75 million, sorry, 100,000 divided by 180 million. Sorry, 75 million, 100,000 divided by 180 million. Okay, asset turnover. Okay, how many times or how many dollars per dollar of investments? So the first one is what? What's the formula here? Sales divided by what? Capital employed. Okay, so the first one is how many times? 0.69. 69 times. Is that 69? 67. 69 times. Or it's $0.69 for every dollar of sale. Do you understand? Okay, sorry, now, 0.69 sales for every dollar of capital employed. You understand? Okay, so those are how you interpret it. How did you get this? What was your sale? Sale was 150 million. What is your capital employed? How did you get capital employed? Capital, which is how much? So your capital was 92,900, is that correct? Plus what? Okay, what is that 125 million? Your non-current liability. understand? Your non-current liability. Okay? What about in 2006? What is it in 2006? How many times? 0.61 times. Very good. What did you get? Again, 180 million is your sales. What is your capital employed that year? 146,700 plus what? 150 million. Yes? Correct? Have you gone to ROCE already? Not yet. What's the formula for return on capital employed? PBIT? Yes, correct. Divided by CE, correct? Okay, now I know it's there, but I keep repeating it so you don't forget it. Okay? So, which means, what was my return in 2005? 28.2%, correct? What did you do? What is your PBIT? PBIT is 61,500,000, and of course, your CE is the same as the turnover calculation, correct? Yes? Very easy. How about in 2006? It's 75 million divided by 146 million plus 150 million. Is that correct? What is our return on capital employed? 25.3. All right. Good. Very good. But you tell me. Tell me and interpret for me the results of this company. Let's talk about the GP first. So from 2005 to 2006, gross profit margin, did it become better or worse? Better. What is the situation that made it possible to become better? What are the possibility? Okay, what happened to the sales? Okay, so it can be increased by, but if it's sales only, it may not be, if it's sales, be specific. What in sales? Is it the quantity or the selling price? Okay, so let's stick to the first one first. Sales. You said to me it's because of the sales increase. Well, what in the sales increase would actually help the GP? Is it the selling price increase or the quantity increase? The selling price, more specifically, because if the quantity is increased, but the selling price has not increased, really the GP will still be the same. Do you understand what I'm saying? The GP will still be the same even if your quantity increased. If the selling price does not increase, the GP will still be the same. You understand? The selling price could have been increased. Or it could be, if they did not increase the selling price, it could be, what did you say? the cost of sales have reduced. It's only two things that will affect the GP. Either the selling price has increased or your cost of sales have decreased. Correct. Okay, that is how the interpretation is what. In this case, we are comparing. Remember, how do we compare this good or bad? You can compare with the budget, you can compare with last year, or you can compare with the industry, correct? In our exercise, we are comparing 1 year against the other year. Question? Well, in net profit? Net profit is operational margin. Net profit is operational profit. This is that when we say net profit margin, it's usually the operational profit, which is the PBIT. PBIT is your your profit from operations. Your net profit is after you deduct your taxes and your interests. I'm not sure if I got your question correct. What is your question?
Actually, I know that this is operational
Profit margin. Yes.
It is not like profits margin.
Yes, but normally they say net profit, but they mean operational profit. Okay, I understand. All right. Now, normally when you say net profit, they actually generally mean PBIT. You understand? Okay. Net profit margin, they usually refer to the operational profit. Okay. That's how.
It's the question that to calculate net profit margin. So which one is the first?
Okay. When I mean net profit here, I mean the operational profit. And usually that's what they mean. When they say net profit, they refer to the operational profit. Okay, you understand? So generally that's how they term it. Okay, when they see net profit margin. Unless they really get you to net income, which is actually after deduction of taxes and interest. Okay? Yes, the same. But when we say in performance measurements, net profit margin, they refer to operational profit. Okay? Unless they state after. Unless they say that it is the net profit after interest and taxes, which means that is really the net, okay, the net income after. Okay, net profit or net income. But when we talk about net profit margin, we refer to net profit from operations. Yeah. In this case. All right. Now, let's look at net profit. Okay. Between 2005 to 2006, it's almost what? It's almost the same. Now, look what happened. Your gross profit increased by how many percent? By almost 4%, correct? But your net profit only increased by how much? 0.7%. Okay? Therefore, what could have been the change? Why is it like that? Okay, it could have been high other operating costs, which means what? Marketing, probably, and advertising. Okay, marketing and advertising. For example, why will I say that? Because if I look at the sales, look what happened to your sales. It increased from what? From 150 million to 180 million. That's 30. How many percent increase is that? Can you see? How many percent increase is that sale? 20% increase. Imagine a 20% increase in sales. They must have done something. They must have spent some, because normally administration would be almost fixed, correct? Okay. But what changes is the marketing and advertising. Okay, so they could have spent a lot of that. That's why there is not much of an increase in the net profit, okay, margin. Okay, now let's look at the asset turnover. What is the asset turnover again? The asset turnover is your sales divided by capital employed. But really, did it go up or down? It went down. But the sales went up. Yes? How come? Look what happened to our capital employed. What happened to the capital employed? First, look at the capital here from 92 to 146. And the long-term debt increased from 125 to 150. What happened to the capital? Why did there, usually the capital is the same, correct? Yeah, can you check what happened to the capital? They what? What increase in the capital? Is the retained earnings, understand that? Revaluation. Revaluation reserve, which means revaluation of assets, correct? Ooh, that has increased. So not really, the decrease in your sales is not because your sales your decrease in asset turnover is not because your sales decreased, but what? But the capital employed increased. Not because you employed more capital, but they revalued their assets. You understand? They revalue their assets. So do you understand how it's coming out now? Okay. Now let's take a look at the last one. Return on capital employed. Now, went up or down? Down. Why? Is it because their profit decreased? No, actually, look at the profit from 61 million to what? 5 million. But this ROCE was because your capital employed has gone up. You understand? Okay, so you see? Yeah. Interesting, isn't it? Okay? So good. So those are our profitability calculations, and you just had an analysis on the same. All right, let's see. Let's continue on. All right. Let's go to cash. Okay. All right. So in here, in our cash performance measurements, we will need to look at liquidity ratios and again learn to interpret them. Okay. In comparison to last year or in comparison to other businesses. And you need to know how we can discuss how it can be improved further. Okay? It could be improved further. So, formulas. Okay? Oops, sorry, what happened to my formula? Is your formula okay there? Well, why is mine is dancing all around? Oh, it's always like this. Okay? The system doesn't like me. All right. Okay, so first is current ratio. Okay, current ratio, current assets divided by current liabilities, that's easy. Quick ratio, your current assets, but you take away the inventory divided by current liabilities. Let's talk about these two. What is the first one? What does it mean? Current ratio. It measures the company's ability to what? To pay its debts using its current assets. Okay? Quick ratio. Current assets minus. So yeah. So why do we take away the inventory? Okay, so remember, I want to know if my liability becomes due immediately, how fast can I pay? Now, why we take the inventory out? Takes you time to sell it, correct? Now, it's good if your inventory is only finished goods. But sometimes your inventory includes work in progress and raw materials. Now, if the finished goods is difficult to sell, try selling the work in progress. Try selling the raw material. So you take the inventory out, right? Okay. So, right. So those are the two. Now we will talk about which is good or bad. Okay, in a moment. Receivables period is your average receivables divided by the credit sales. Now, in the absence of credit sales, you can take the sales, correct? Okay. What does it measure? It measures the number of days, that's why you multiply it by 365, the number of days you take to collect your receivable. Okay. How about payable? Let's go down to payables. Payable period is your average payable divided by your credit purchases, or in the absence of credit purchases, you can just take purchases. What does it measure? Okay. How long does it take the company to pay its suppliers? Okay. Inventory period, average finished goods divided by cost of sales. Measures what? Okay. Two things. It measures how long it will take you to sell what you have in the inventory. Okay. Or it tells you how much of days do you have goods to actually sell. Okay. In other words, how many days or months do you still have something to sell? Okay. So, all right. So current liabilities. Okay. Current liabilities. Okay, but before it. Current liabilities. How do you know it's good or bad? Yes, at least 2:1. 2 of assets, 1 of liability. That's the least acceptable. Higher than 2:1 is good, but lower than 2:1 is not good. Okay? How about current ratio or quick ratio? This one is 1:1. At least 1:1. You understand? One quick ratio, a quick asset divided by, or one quick asset to one of current liability. Anything lower than 1:1 is not healthy. Okay. How about receivables period? Should be as high as possible or as low as possible? As high? You want in receivables to be high? In other words, you want it longer days before you can collect? No, you want it shorter days, correct? Okay, the shorter, of course, the better, because you need to turn around your money for your cash flow, for your working capital. Okay? How about payables period? The longer the better? Or the shorter the better? I don't like to lend you money. Okay? Yeah, you can say the longer the better, but it's not good. You should be the longer within the what? Within the credit limit that is given to you. You understand? Because if you give it the longer the better, nobody will anymore lend you money, understand, or lend you goods or deliver to you on credit. Your credit rating will be very low. Okay? So yes, the longer the better, but within the credit limit given by the supplier. How about the inventory period? The shorter the better, the longer the better? Shorter? Well, it depends. Where do you think it depends? Yes, it depends on your product. If you're selling bananas, of course, you don't want it to be 30 days, you understand? Alright? Or, okay, you understand? Or it can be also that depending on the source, if you're a buy and sell company, and it takes you, for example, 3 months to get your new stock. You have to have enough stock for 3 months of sale. You understand? So you don't have a stock out. You got that? Okay. So it really depends on the product that you're selling, or the material that you need. Okay. So it is your inventory period depends on that. Okay. All right. Good. Now let's see. Okay, I have enough time. Looking at the example I gave you here, I need you to calculate for me. I think that will be how we're going to end the evening. I need you to calculate. So let's make a deal. If you get it all right, then we go home, huh? So liquidity ratios. Okay, I need the following from you. Number one, I need current ratio. Okay, remember I have 2 years here, 2005 and 2006. Next one, I need your quick ratio. Number 3, accounts receivable payment period. Let's see. Accounts payable payment period. Next one, inventory turnover. ratio, let's see. At least these two. Current ratio, how many? 2 point what? 2.2, 2.3 is to 1. 2006? 1.9 is to 1. How did you get that? How did you get current ratio? What is the formula again? Current assets divided by current liability. Oh, so what's the current assets? It's not 240 million. This is what I was telling you. Understand your financial statement. The 240 there is the including. Okay, so what is our current asset therefore? Only what? Only 50 million. Okay, divided by what is your current liability? 22. Okay, 1,100,000. Correct? Is that correct? You got it? You understand? That's why I said understand your financial statements. Okay. So what is it in 2006? 2006? 64,300,000. Sorry, divided by 33,800. 33,800,000. Okay. So look at that first. Did it increase or decrease? It decreased. Yeah? In 2005, is it still okay? What did we say about current ratio? Should be what? 2 is to 1 at least, correct? So in 2005, is it still good? Yes. But in 2006? Still good, but it's going down. So it's something to be worried about. Something to be worried about. You understand? Okay. It's because it's still almost 2. But really, we are already on the borderline. Okay? Borderline. Quick ratio, therefore. What is our quick ratio? 1.7 is to 1. And the other one, that 2006? 1.5 is to 1. Yes? Remember, you just take out the inventory. Okay? Inventory. Alright? So really, it's what? So it was 45,500,000, correct? Divided by the liability remains the same. How about in 2006? Sorry, I'm wrong. What is it? 38 million, sorry, 38 million. And in 2006, it's what? 49,300,000. Is that correct? Yeah, okay. 33,800. Yeah? Okay, good. Alright, have you finished with the payables, with the receivables? How many days? Okay, not yet. Okay, can you continue? Accounts receivable payment period, accounts payable payment period. How many days in 2005? How many days? 90? 91 days. How about in 2006? Became what? It became 100 days. Okay? So, what was the receivable in 2005? Okay, 37,500,000. What was the sales? Okay, we don't have credit sales, but we have sale, 150 million. Yeah, you understand? Okay, so in the absence of credit sales, you can use the total sales. 2006, what was the receivable? 49,300. The sale was 180 million. Yeah? Is that good or bad? Well, if you compare from 2005 to 2006, did it become better or worse? Worse. It's receivable, right? You want it, the shorter the better. Is 91 days too long or too short?
Long.
Okay? Although we don't know how many days is their credit, correct? But it's how many months this one?
3 months.
3 months. Do you usually give 3 months credit? No. Normally it's about a month, correct? So already as it is, it's not a good, and you know why? Why also they increased the number of days from 2005 to 2006? You remember, their sales become higher, correct? So what happened? They could actually have what? Offered what? Offered customer credit, okay, more credit. In other words, offered customers that usually buy on cash, they offer them credit so they can get more sales. Do you understand? So, and some, if you do not apply your credit policy very well, what happens? Okay, either customers take long time to pay, you understand, or they don't pay at all. You understand? Because you relaxed your credit policy. You did not follow your credit policy very well. So you did not screen the customers in terms of their credit viabilities. Okay? Their credit standing. Alright? So you will have longer receivable periods. Payment periods. Have you done it already? Not yet. Yes? How many days? Okay, so 2005 is what? 65 days. In 2006? Okay, so almost the same, correct? 65 or 60, no, 68 days. Let's say, let's round it off, right? Okay, almost the same though. What did you do? What's the payable? Payable is okay, 10,600,000. What is your cost of sales? 60 million, yeah, okay, 60 million. How about in 2006? What was the cost, what was the payable? 11,700,000, and the cost of sales is what? 65 million, okay? So almost the same. 2 months before you get paid, and before you have to pay your supplier. And you already see that this company has a working capital problem. Do you see it?
Yes.
Do you see the working capital problem of this company?
Yes.
Yes. They pay their supplier in 2 months,
Yes.
but they get the money from their customer in 3 months. Where are they going to get the balance for the 1 month that they need to turn around the money? You understand? So we have a problem here. Well, do they have enough cash? Do they have enough cash? Let's take a look. Cash in bank is very low. It's only 500,000. You understand? Okay, so they will have a profitability issue, this company here. Inventory turnover. How do you calculate inventory turnover again? Cost of goods sold divided by, inventory divided by cost of goods sold, reverse. Okay? Now, how many days? So 2005, they had 73 days of inventory. Hmm? Yes. Don't say turnover here. Don't think about turnover as sales in this. Turnover means how fast you sell it. Okay. No, it's actually inventory divided by sales. It's not the same like asset turnover. Two different things. Okay? Or sometimes they call it inventory days. They could call it that. But some they call it inventory turnover. Okay? How about 2006? How many days? 84 days. Okay? So, what happened here? Okay? What is the formula again? Inventory. What's our inventory? Year 1, I said 2005. Hold on, where am I? 12 million. Okay, and divided by what? 100 and, sorry, divided by cost of sales, sorry, 60 million, correct? Don't forget, this is all multiplied by 365 days, huh? Multiplied by 365 days. Alright? How about 2006? What was the inventory? 15 million. And of course, 65 million multiplied by 365. Why did the number of days increased from 73 to 84? Yeah, why did they increase? Remember, they tried to sell more, correct? So in the process of selling more, they had to build inventory. Remember what I told you earlier. They increased their marketing expense, correct? So when they paid for marketing and advertising, they expected that their sales will increase, correct? So what happened? They produced and produced and produced. And so the effect is that if they don't get sold, they go to the inventory. Hmm? And also, it's a long time. We don't know because we don't know what their product is. So we don't know if it's long or just enough number of days. As we said earlier, it depends on. Okay. So good. Okay. All right. Tomorrow we will continue with gearing ratio and non-financial profit indicators. Okay, and the rest of the formulas. All right, so I will see you tomorrow afternoon. Okay. Again, as I was saying, thank you for waiting for me, and I'll see you tomorrow afternoon. Okay. And I texted me saying, "Ah, you're missing something there." My mistake, I put it in my bag.
That's why teacher wants to go to the time.
Ah, my God. I was so nervous. I said, wow, I don't have enough time. Okay, I'll send this tomorrow. Oh, no, yes. Wait it. Me, boy, na, boy. Okay. So for me. It's okay. That's not okay. Ah, okay.
Is it the traditional dress?
Oh, this one, yes. This is our traditional cloth and this is traditional design, yes. But underneath is Cambodian silk.
So actually it's only one layer.
Yeah, this one is this one. Is our national dress. Normally you wear something underneath it. Yeah, so you wear something. So in this case I wore Cambodian silk.
Normally something underneath nature.
Dress also.
Whatever.
Yeah, whatever you like. Some
And-
is dress
Okay.
and you put
So this is just the over.
yeah, kind of like an over. Yeah. Some people really put a lining in it already and wear it like a dress, depending on the design.
But if it is not very clean, can wear it.
Yeah, but it's very thin. Yeah, you have to have something. Some people make it like a dress and then they put a lining. Right.
Nice. So oh my god, I struck something here. It's big glass.
And it's kind of like a fabric from pineapple.
Pineapple.
Yeah,
Oh,
pineapple fabric. And
pineapple.
they make it pineapple fabric. So it's very, very